The Platinum Group of Precious Metals is on the agenda today, and Henk De Hoop, CEO of SFA Oxford, joins us to shed some light on PGMs on this episode of Silver Bullion Television. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vierra, part of the outreach team of Silver Bullion here in Singapore, where we want to help you truly secure your wealth. Henk De Hoop, SFA Oxford, CEO, joins us today. Henk brings a wealth of corporate experience to SFA, working for nearly 30 years in both mining engineering and mining finance. And we're delighted to have Henk join us today. It's time to saddle up and silver up for Henk De Hoop. Henk, welcome to SBTV. How are you doing?
All good. Thank you very much for having me, Patrick.
Before we start off, can you tell us a bit about yourself and about SFA Oxford?
Sure. I'm the CEO of SFA Oxford. My background is mining engineering and finance. I've spent the last 30 years in South Africa and the last 3 years in Oxford, where we're based in Oxford Science Park. SFA Oxford has been covering platinum group metals and battery metals for over 22 decades. We have clients internationally. A lot of the producers are our clients of our research. We do price forecasting, supply and demand forecasts. And we have a lot of industrial consumers of these metals as clients as well, in Japan, US, Europe. So a truly global audience. And those contacts with those clients, including the hard disk manufacturers, give us great insights on what are happening at end to end demand for these metals. That helps the producers, and it also helps the end consumers to know what the producers are up to and how they're planning production going forward.
All right, quite the space. We'll touch on a bunch of those things shortly. Hank, you're coming off of Shanghai Platinum Week a few weeks back. What were some of the reports or outlooks for platinum or the PGM group that stood out for you?
Thanks. Shanghai Platinum Week was in its 5th edition, and it's growing by leaps and bounds. So there were over 600 people there. It has a huge online audience. We just got that through this morning. There were about 500,000 people logging in. What was very impressive, I think, is we did site visits to the jewelry manufacturers. There was clearly a surge in March, April of metal going into the jewelry manufacturing sector. There were a couple of reasons. First, because of the gold price being that high, the retailers had noticed that foot traffic and the willingness to buy jewelry at those high prices was starting to dim a bit for gold. And as a result, they said, let's try, we can put some more platinum in the stores. Jewelry manufacturers that are pure platinum are quite few and far in between. There were less than 10. There are now about 30 that are starting to manufacturing jewelry in platinum to send to the wholesalers that is now getting into the shops. So what still needs to happen is convince the retail clients buying platinum. And that probably needs a bit more marketing still to come. The other aspect in China, which was very interesting, was China has picked up, as platinum prices started to move, on investment bar demand. It is going through in very large volumes. It's you ask the people there, they're making 10 times as much as what they did last year in bars. It's partly, again, people have already stocked up on gold. That gold price is starting to slow down in its rise and now looking for an alternative. And it doesn't need much of that gold cash or cash that was looking for a home to move into platinum for having a big impact on the platinum market, because it's so much smaller than the gold market. Platinum market is a tiny percentage of the gold market. So if some people start to think we're going to put some money into platinum, it can have a big impact on the price. There was an example of a CEO of one of the recycling companies who did mention that some of his friends had started to invest in platinum, and each one of them had started to invest hundreds of kilos of platinum bars and basically stocking up on that. So the numbers are quite impressive, and it does explain why the import statistics that everybody could see in the first few months in China were as impressive as they were. It is sucking up liquidity. And the big question going forward will be, will that momentum be sustained? Because if platinum prices would come off, you probably will see some of those investors delivering back into the market. But at the same time, the property market in China is not doing well. The share market is not doing well. People are looking for alternative investment products. And it's starting to spread across different metals, including tiny metals like iridium, ruthenium, are being picked up by the Chinese as investment metals. So it was a very positive story, to be honest.
Yeah, I agree with what you're saying because here in Singapore, I can tell you there's an interest that's picking up with platinum, and I think platinum it's in a very nice space right now. It's in between, I'll just say in between gold and silver as that middle ground where uh, they see the potential that platinum has, and if I guess let's say they sort of missed gold, this is their other opportunity right now to jump in on platinum. So I completely I see exactly what you're saying. I saw your presentation at Shanghai Platinum Week, and what caught my eye was how sparse the geographic distribution of platinum, or even the platinum group of metals, really are. Where would you say are the highest concentration of PGM deposits?
You're absolutely right there, Patrick. And that makes these metals so unique. The bulk of these metals get mined in South Africa. Then Russia produces it as a byproduct. So the uniqueness of South Africa is it's a primary product. You start a mine because you believe in PGMs. In Russia, you mine nickel, you mine copper, and the byproduct is PGMs with a heavy emphasis on palladium. The third large resource is in Zimbabwe, which is less well developed, but it's a great ore body. That metal and those ore bodies are controlled by the South Africans. They own those ore bodies and they process that metal. So the South Africans are like the key source of these PGMs. A separate future and current source is also recycling, because these metals are recyclable. They don't degrade as you use them. You can actually recover them to call it the full quality that you get fresh metal from. So a big resource at the moment, secondary, is from car scrapyards. You take your car apart, you take your converter, your catalyst off, and that gets recycled through the stream. And a lot of the flows in PGM secondary are coming at the moment from the US, because they have big engines and they had like lots of palladium on them, lots of rhodium on them, to a certain extent platinum as well. And that recycling stream is quite an important contributor to provide liquidity in the market as well. Because what we've seen in platinum in the first half this year, for example, the 3 of the 4 producers had issues in either on refining these metals or had a mine flooding, and it causes then liquidity issues in the market, because they sell a lot of their metal on long-term contracts. 80% of the metal they produce is often on long-term contracts, so it never sees the market, and the rest goes in the spot market. So if there's a shortage of production, the spot market will notice it quite quickly. And as a result, there will be quite violent responses in price. And if you look back over the last 10, 20 years, there have been periods where these metals go absolutely bonkers. They shoot up because there is this disruption in the chain. There's an illiquid spot market, but you still need the metal. If you want to produce cars, you need the metal. If you want to produce glass fiber, you need those metals. And these prices can go quite wild quite quickly, because the supply base is so concentrated and is so dependent on less than a handful of producers, essentially.
Yeah, that's another great point because with even with just the bullion in the bullion space, platinum particularly, um, there seems to be a feeling of there is a bit of tightening with platinum, and not sure if that's because of the supply. Maybe the demand is getting high, where supply can't keep up with it. But from where you sit, what is there a tightening with platinum?
If you look at this in the call it the last 6 months, absolutely. And I think platinum is coming out of let's call it a 10-year period when whatever happened in the markets, the price would hardly move. And it was partly because in the decade before that, let's call it 2000 to 2008, 2010, there was a lot of ramping up of capacity. That metal was sold, but not necessarily all consumed or applied. And there's always, for the next 10 years, was always a perception, and it was visible in the historic flows. There's a lot of liquidity around. So whoever needed platinum could find it. It was stored, it was coming out of inventory. And the China ramp up now, the last 6 months, has shown that liquidity can be sucked up if things start to move in price. And that has happened over the last few months, is that the price started moving, investment demand started to pick up, jewelry started to restock in China. We've heard now as well in Japan, investors started to get interested again because platinum was flatlining. It's now starting to pick up. And where else are you going to invest? It could well be in platinum, and platinum has been a popular investment product in Japan. It's starting to generate interest again. And as a result, the liquidity, excess liquidity is being eaten away very likely, because if you store investment platinum as investment bars, it literally gets put away. So it's taken away from the market. It can come back, obviously, but it does help to call it constrain the availability of platinum. And you can see that in the very high lease rates we have currently. It's a sign that people that need platinum in the short term, need it for a period, cannot find it easily. And there is, on top of called the actual liquidity squeeze, there's also a lot of shifting of platinum storage to areas that are under threat from tariffs. So we've seen a lot of platinum going into the US, for example, to be ahead of the potential tariffs that were being talked about. And I think it's one thing that is also sucking up now the palladium price. There's also a threat that Russian palladium might now be tariffed or banned, perhaps, as these threats of we're going to impose stricter sanctions on Russia come through. And it's one of the areas that people are worried about, because you cannot easily do without Russian PGMs, because there's quite a big portion of that market. And if you make it very difficult to access that Russian metal, it's already tougher than what it used to be. But if you worsen that access, you will have price support for these very scarce metals.
With the price, I think it was not that long ago. I think it was ruthenium that absolutely just had a very good moment. Ruthenium or rhodium, I'm not sure,
Rhodium,
but
yeah.
rhodium. Okay, yeah, it was the price for that. I think it really hit record highs, if I recall, and then but we saw it kind of come back down. So I was just kind of curious what happened with rhodium, where we saw that takeoff and that fallback.
First of all, rhodium is a very tiny market. It's 1 million ounces a year that gets basically produced. You're looking at a metal that is, as a result of its scarcity, largely committed to long-term offtake. 90% of that metal goes to car manufacturers, because it has a very specific role in cleaning up your nitrous oxide emissions from your exhaust. If you disturb that flow, it has very quickly dramatic impacts, and it's probably the most volatile metals of all the PGMs, if not of many other metals out there. It has traded at $200, it's traded at $30,000, and it's now back at about $5,000. In the case of rhodium at the time, there was a disruption to the flow. There were processing issues in South Africa. There was COVID disruption as well. Some of the mines were told to stop and stand essentially for a very brief period, but it does cause like these very sudden shortages of metal production. It's probably also the most concentrated, because 90+% of that metal comes from South Africa. There's a very specific reef that is rich in it. It's probably the ideal metal to have these horrible spikes. And let's also not forget, it seems interesting from an investment perspective, but for an industrial consumer, they hate this. You can't plan production on projecting $2,000, and by the end of the year you're paying $15,000. It really hurts what you do. And what the last spike caused was, for example, the glass fiber manufacturers, they use something called bushings. It's basically a solid piece of 10, 12 kilos of platinum mixed with rhodium, 10 to 20%, to actually make glass fiber, because it's so hard to break down. It's so tough in high temperatures. It's one of the very only metals that can handle that type of stress. They decided this is enough is enough. I'm going to get rid of my rhodium. So they're down to only a couple % rhodium, because the prices were so high. They would like to go back, but they need comfort that rhodium price is not going back to $10,000 or $15,000. And I think that comfort is slowly and surely starting to build. But it shows you that you can lose key consumers of these metals if your prices are too volatile or too high or too difficult to obtain when you need it. And that's the danger a bit that the PGM producers are aware of, and they don't like these spikes. They obviously enjoy high prices, but they last often very short, and then for a short while, and then you go into a bear cycle for a while, and you burn cash again. So everybody likes steady growing prices, but with a market as illiquid and so concentrated, it's very difficult to manage.
Hank, in your presentation, you spoke quite a bit on iridium and ruthenium. What do you want us to know about these two metals?
Important part, it's linked to the earlier points that were made. These are probably the most concentrated metals in the world in the sense of where you find them originally. They're a byproduct. They only make 5 or 10% of the revenue of the PGM producers. If PGM producers stop producing, you will never start an iridium ruthenium mine because they are not there. It's a byproduct. Iridium ruthenium is probably the most concentrated metal in the world, I would say, very close to it. 90+% of the metal comes from this one reef in South Africa. It's a big reef, but it's completely dependent on that. The metals themselves are quite unique. Iridium is one of the toughest metals around. It's catalytically active. It can handle very high temperatures. And for example, in the production of certain electronic components, it's the only metal you can use because of it not messing up with the production process, because it's so tough and tight of a crucible that one uses. And there are no alternatives. In the case of putting an electrolyzer together for hydrogen production, you need iridium. Again, it's putting lots of power through an electrolyzer. It's a very acidic environment. There's no metal that will last long enough to make a fuel cell last for 2-3 years or 5 years, whatever the durability requirements are. So iridium is very unique. And then it's also a tiny market. It's a quarter of the size of rhodium, and it's only 250,000 ounces a year that get mined. So it basically fits in a suitcase. It's that small. And as a result, people are very worried going forward, can we get enough iridium? Because the story in South Africa is at the moment that nobody is really putting new production in the ground. They're battling to keep up with existing production. And we expect over the next 5 to 10 years, the production of iridium and ruthenium to decline. It's a simple, old mines die, no new mines being built. Your overall production starts to come off. And that is where we made the argument in China as well, is that you probably will find that there are some preferential areas where you can only use iridium, and you will want to protect those sectors of demand. There are some areas where you possibly can use some alternative metals that aren't as good, but good enough. And then what needs to happen is a lot more recycling. For whatever you use, you need to make sure these metals come back as much as you can in order to put back into the applications that really need it. We're seeing a lot of new interest. We're selling a lot more new iridium and ruthenium reports because they're very difficult to analyze those markets. Because we speak to a lot of people consuming these metals, we have a very good idea what the future trends are. For example, in the case of ruthenium, it goes into hard disks, and not necessarily the desktop only. It goes in these massive hard disks that go into data centers. Storage demand is growing at a very strong pace. It's still the cheapest way of actually storing, because you obviously have solid state storage as well, which doesn't use ruthenium. But the good old fashioned hard disk, and we shouldn't forget this is quite high tech hard disk with gigantic storage capacity, the volumes are growing quite fast, and you need ruthenium for that. And we initially thought there's going to be an alternative technology that's going to be even bigger, but the cost of that technology for now and the scaling is going to take many years of heavy capital investment by the industry. So we still see a very strong ruthenium demand coming through from the hard disk sector, for example, as AI starts to accelerate, as the capital starts to go in, and as the storage requirements for the world actually increases quite rapidly.
Yeah, okay. Thanks for answering that. I was going to ask you the question about AI. I mean, considering the massive data centers that are going to be built, the power consumption, all of these things. So the question was, which you answered, can PGMs keep up with that that new industry that's really going to be a beast and just really chomp through everything. What happens if, let's say, supply not enough supply for that demand of the AI boom, I guess?
What happens with most of the metals that go through a stage of extreme demand, first prices will start to rise. So you will likely see ruthenium prices rising further. On the back of that, whoever consumes this will start looking either at thrifting, using less of that metal. Can we minimize use? Can we go down to an atomic level and see, can we actually make this application work with less of this metal? Is it still as durable? Is it still as efficient? Then what they will look as well, are there alternative metals we can use? Are there any options technology-wise where we can move away from this metal? And in every metal consuming industry or section, there's a pie chart of applications, and some of those application pie charts will shrink, and it's how the industry will manage. What it also does on the other side is that will a combination of higher prices, and remember in PGMs, you can have a ruthenium price, and that's what I tried to show in the presentation as well, of $2,000 or $3,000. It will not be the trigger to start a new mine because it's too small a contribution. But if platinum is going well, palladium is going well, rhodium starts to recover, and the minor metals, you will probably find the justification in time again. Let's start up these mines. The prospect of these metals look a lot better. But that takes time. It's 5 to 10 years for a shallow mine, and it can take 15 years to 20 years for a deep mine to get into full production. So it cannot respond quickly to sudden shocks to demand, positive shocks to demand. So there will be a period of high prices, there will be responses, and then the final thing that will happen is recycling, and recyclers will start to be aware of this. They never used to recycle spark plugs. Spark plugs often have milligrams of iridium, so it doesn't make any sense at $500 an ounce of iridium. At $5,000 an ounce for iridium or higher, recycling with spark plugs will happen. And we saw that in China as well. The recyclers are starting to collect spark plugs to chop up the tip to get the iridium. So it's a source of feed of material that wasn't there before, stimulated by higher prices, and hopefully then rebalance the market to a certain extent.
You mentioned with the mining, you mentioned how the older the mine is, the deeper you may have to dig. At what depth are you mining? And I'd have to imagine logistically, this is a challenge for an operation at depth.
Absolutely. And South Africa has some of the deepest mines in the world, first of all. The gold mines started in about 1886 in Johannesburg, and they're on a plain, and the deepest one have now started to reach 4 kilometers deep. It's kilometers, not 4,000 feet, it's kilometers. It's an incredible engineering feat. You get then lots of issues. First of all, in the gold sector at that depth, the virgin rock temperature is about 60 degrees Celsius. So you need to put enormous power requirements in because you need to cool. You need to either send ice down or you need to cool air on surface, pump it down in order to get your temperatures below 30 degrees Celsius so people can work there. You also get a lot of seismicity. So a lot of the rock is now taking so much pressure. As you move the rock away, you need to leave bigger pillars, so you mine less of the stuff. You also have to put lots more support in, and it slows your process down. So it forces eventually mines out of business depth. In the PGM sector, we started later. So the first mines were in the 1930s or so. We've reached the deepest mines now about 2 kilometers. But the geological heat in that area of the world is higher. So at 2 kilometers, you already hit 60 degrees Celsius. So those same platinum mines that are only half as deep still need to pump a lot of cooling air in. They also have lower extraction rates, bigger pillars they need to put in to make sure it stays safe, higher cost of actually supporting the roof. And as a result, the economics of these mines are getting squeezed. The worst thing, though, is that when you decide to spend $2, $3, $4 billion on building these mines, you will have to wait 15 years before the returns are there. Now, look at where we are now. We're 2025. Look at where that mine will be up and running, 2040. What will the world look like? Will there be battery electric vehicles all around? Will there be still the main category of demand for PGMs is still the combustion engine? How many combustion engines will still be produced at that stage? And the boards of these companies are a bit nervous now to commit to these deep level projects because the returns are so unpredictable, and the investors' willingness to wait that long for that big investment to have a return is starting to actually slow down the reinvestment rate. And it's, I guess, the great story behind PGMs is the primary guys, the only guys, or one of the very few guys in the world that produce it, are starting to decline that production because they don't see the justification of sinking deep shafts. Yes, there are a couple of shallower projects that are being considered, but they're often palladium heavy. And palladium is not necessarily, the platinum outlook is for, or the palladium outlook is not as strong as it is for platinum, or it is for rhodium. And as a result, not everybody believes those projects will be as big as they say they're going to be, or that they will eventually get into production at the scale that the current people behind these projects will produce them. And we therefore think there's particularly on the platinum side, a very strong story behind it, because your primary production is starting to come off, and it's still a great metal to actually, that the world requires to either for the hydrogen economy, for a lot of industrial processes, a lot of your oil production, for example. In refineries, you have very large consumption of platinum to make some of these catalytic reactions work that make your fuel. A lot of chemical plants use it. A lot of chemical plants depend on these catalysts to work and make processes efficient. So there's quite a bit of called solid base demand, but the fresh metal coming out of the ground is getting tougher to get hold of because of the depth issue that you mentioned.
Yeah, I when I was looking into this, I also took a look at the 50 most critical minerals, at least for the US anyway. And there was your PGM group: palladium, platinum, iridium, rhodium, ruthenium was in there. And then I also stumbled across, when you mentioned electric vehicles, nickel, cobalt, lithium, graphite. So it seems wherever you move in this PGM space, or wherever SFA is, these critical elements, minerals, they seem to be there. So I guess for a mid to long term investor, uh, this may be a good space to take a look at. Would you do you see that same outlook?
I certainly think in the PGM space, because I think this structural longer term picture that we're seeing of the bulk of the production coming off from South Africa. But in nickel and cobalt, there are different dynamics. That is a bit less clear, I would say. Partly because the Chinese stepped into Indonesia, and Indonesia is now the biggest producer of nickel in the world. They imposed an export ban on raw nickel ore, and as a result, the Chinese came into Indonesia, started processing it, and when the battery boom started to take off, they started to put massive processing facilities in, to the extent that they went too quick, too fast, too big, and the nickel went into oversupply. There's a second reason for that, is that the boom in batteries that everybody expected to be based on NMC batteries, which contain nickel and cobalt, partly because nickel rose to $50,000 a ton, partly because cobalt became expensive, the Chinese started working on alternatives. So the most common batteries going into either storage or into fixed storage or into cars are now lithium iron phosphate, LFP batteries. So they don't use nickel, they don't use cobalt. Nickel and cobalt batteries are still the premium batteries. You want to have them in your Merc or your BMW, but there is a far bigger likelihood of the cost of those batteries over time being more volatile. First, they were always more expensive than LFP. They're definitely better. And it's going to be a blend of batteries we're going to see in the future, dominated by LFP. Nickel and NMC batteries are going to have a place, but that growth has been tempered down a bit. The full weight of the expansion and the capital thrown by the Chinese into Indonesia hasn't materialized. So we're still seeing more and more nickel coming out of Indonesia in the years ahead. They were also quite strategic in buying up the bulk of the cobalt assets in the DRC, where 70% of the world's cobalt is coming from. And they are dominating that space as well. So you will find it very difficult to outpace or find alternative large cobalt resources, because one of the things that they found out in nickel there in Indonesia, there's a little bit of cobalt in that ore as well. They've started to recover that now as well. And guess what? In the hands of the Chinese again. So it's at the moment, cobalt prices are very steep. The key reason is not supply and demand. The key reason is that the DRC government said no more exports of cobalt as is. We're putting an export ban in to manage prices, because the overproduction caused prices to collapse. And they said, let's ban exports for now. Let's put an export licensing system in place. And that's holding back cobalt exports. Prices have shot up because artificially created scarcity. But it's a very dangerous bet, because if 6 months from now the government changes its mind, very likely, because there's so much stock building up in the DRC, these prices will fade again. So cobalt is not really what we see as an investable commodity because of government regulations actually holding that back. Nickel, we're also less optimistic on because of this oversupply and capital that has been committed, and this battery change in technology that is going to hold that back. And then finally, you've got lithium. Lithium demand is not an issue. We see that continuing for many years ahead. The battery electric vehicles, people might be skeptical on it, but every year there's more of them sold. There's more model availability. Smaller models are coming on the market, cheaper models coming on the market, and the Chinese are starting to export in a big scale. But also the Volkswagens, the Kias, the Hyundais, the BMWs, they're all bringing more and more models, electrical models to the market, and they're getting better and better. There's also a big fixed storage story still. There's a lot of extra storage we need into green grids. If you don't put batteries in the grids over time, you will not be able to actually make this green transition happen. And yes, things have slowed down. People are a bit more cautious on the green transition. Trump has come in, basically put that aside, stopped subsidies. Europe is still committed, but has to now spend a lot more on defense as well. So will they have enough money for the remaining green initiatives? And they're starting to tone down as well some of the ESG requirements that everybody has asked for in the past. China is still the driving force. They are massively investing in solar still, in green resources, putting a lot of extra batteries in the grid as well, electrifying fleets faster than anyone else in the world, and they're very impressive. Their cars are cheap. They are very good as well. Software-defined vehicles. They can come up with new models within 2 years. A Western company takes 6 years. Technology that they're showing in batteries is phenomenal. They're bringing the first cars out that can charge 400 kilometers in 5 minutes, not enough to fetch a cappuccino, essentially. And so it's moving at a rapid pace. So the lithium side is, we think, reasonably strong on the demand side, where the big question mark is, because of this boom in lithium prices that shot up to $80,000 a ton, you had plenty of people chasing assets and starting mines, and the Chinese again starting a lot of those mines as well. There's about 6 years ago, we tracked about 20 to 25 lithium projects. We're now tracking 550 lithium projects. The world is not short of lithium. You can find it anywhere. Yeah, some projects are good, some projects are so-so, and some projects are plain bad. But there is enough lithium. It is being chased by capital. There will be mines that will be closing because they probably never should have either started up or not being able to go through the painful low price period we're seeing now. But lithium production will keep on rising. As a metal or as an investable metal, it's going to be probably another 2 or 3 years of lowish lithium prices before that supply demand resets itself. And hopefully we'll get some better lithium prices, because there's quite a bit of pain in the production side for many producers at the moment.
Well, Hank, you've shared and given things that I can safely say many of us did not know about, and found your, I'm going to say, your wisdom to be a great motivator for us to understand more about PGMs. And because of that, if we do want to understand more about PGMs, how can we, let's say, contact you or learn more about it?
SFA Oxford is basically open to also private clients. We produce regular reports. We have a great website with lots of information as well. We organize seminars as well and conferences, either in London, New York, or South Africa. So we're quite happy for anybody to approach us via our website. There's an email, info@sfaoxford.com. They can approach us on, and we're more than welcome to answer any questions that people have.
Henk De Hoop, I want to thank you, and I hope we can do this again soon on maybe perhaps more of the battery metals and materials.
Happy to do that. Thanks so much, Patrick, for your time.
Thanks again. Appreciate it. That was Henk De Hoop sharing his insider knowledge on the platinum group of metals. To get more of Henk's views, go to www.sfa-oxford.com. If you like this video, please do subscribe, share, and give it a thumbs up. All are greatly appreciated. Audio-only versions of this interview can be found on iTunes and Spotify.